Hello, everyone, and thank you for joining us this month for Side by Side Digital. I'm your host, Rebecca Shively, and we have got a great program lined up for you today. We're joined by Brittany Wonderchuk, aka the Farm Girl Next Door. Brittany and her husband have a row crop operation in Northeast Nebraska, and she has a tremendous amount of expertise when it comes to grain marketing. We're so lucky to have her join us today, as she has a passion for grain marketing and specifically helping people become more confident and comfortable in their grain marketing decisions. Brittany, we're really excited to have you with us today. I'll go ahead and turn it over to you.
Okay, well, thank you again for having me. I am thrilled to be here. Any day that I get a chance to connect with other young farmers and discuss grain marketing, to me is a fantastic day. So I'm excited for this session. I hope that you guys are too. And to start it off, I just want to know how many of you have ever felt like this? This is a meme that I had on my social profiles a while back that everyone seemed to really relate to. So a lot of times you sell grain and then, similar to Buzz Lightyear, someone says, "Did you see the markets?" The market rallies big next day and you sit there looking like Woody and inevitably start feeling a little bit regretful. And the opposite happens too. You don't sell grain, the market plummets the next day, and you, of course, regret not selling. So I'm not saying that after this session, the emotions of grain marketing will completely go away, but we are going to discuss some ways to reduce that emotion to help make better grain marketing decisions. So before we get started, I want to give you a little insight into myself as well as how Farm Girl Next Door got started. So I grew up on a farm in Northeast Nebraska in the same area that my husband and I currently farm. But other than hearing my parents discuss grain marketing decisions, I wasn't really involved in that, as I'm sure many of you can likely relate to. We're taught how to run equipment, drive tractors, do chores, lay irrigation pipe, but no one really sits down and explains the revenue generation side of things through grain marketing. So it wasn't until college that I was introduced to this field. I did internships and worked in merchandising and origination, but when I started out, I had the hardest time understanding basis. For me, it was such an elusive concept, but I worked a lot on farm with farmers and I helped them with their marketing. And I assumed that everyone who was back farming understood all the concepts in marketing, the jargon, things like that. But I found out that it wasn't just me that was having trouble finding the knowledge I needed to hit the ground running. The lack of grain marketing understanding stemmed much further beyond just me starting in my career in the industry. It was more prevalent than I could have ever imagined with the farmers that I was also working with. So I started digging into why. And it turns out there are a lot of pretty boring resources scattered all across the internet, but no relatable, accessible, and interesting step-by-step education to help you hit the ground running. So when I recognized this need, I decided to start the Farm Girl Next Door platform with the goal of education and helping farmers, new and beginning farmers, especially landowners and ag professionals, with understanding grain marketing. So I wanted to make it easy and fun to learn about from someone who's also in your shoes day to day. And I am not a commodity broker. I do not work in merchandising and origination for a grain company anymore. But I am in your shoes making these decisions each day. So I have a blog, social media channels, and 2 online courses now, Cash Grain Marketing 101 and Grain Marketing 201, that all focus on teaching the fundamentals and basics of cash grain marketing, as well as futures and options in a fast, step-by-step way. So even with my personal experience selling our grain on our farm and my professional experience working in the industry and creating these resources, it's still challenging sometimes to keep the emotions at bay when it comes to making grain marketing decisions. So to start off this session, I want to begin with a quote that I personally refer back to often because it gives me quick perspective when I start to get nervous or apprehensive about the grain markets. And that is that we should never go into making grain marketing decisions with the intention of hitting a home run. The goal really is to make a profit and be in business next year. So today we're going to talk through 3 things that will help you feel less at the mercy of grain market fluctuations and instead more in control of the price that you receive for your grain. So the first one being forward selling. The second, determining your cost of production and using that to create a grain marketing plan. And finally, we'll wrap it up with the importance of understanding the different contracting options that you have in order to implement that plan that you put together. So let's begin with number 1 and talk about forward selling. So I enjoy starting things out with analogies to help solidify the concepts and give you something to think about as we move through. So we will do that right now. I recently had a birthday party that I was attending for my niece and nephew. And their birthday does not change each year, as we all know. So buying gifts was something I had an entire year to prepare for. But of course, I waited until the last week of their party. So had I been more prepared, I could have shopped around, found some sales, and I'm very price sensitive. So it was stressful for me to not be able to shop for any deals. I also was limited by what could ship by the time that I needed to leave for their party. So I had to be price insensitive, which was driving me crazy. And if you wait until the last minute, you just simply have fewer options. So what the price was that day was the price that I ended up having to pay. If you think about that with marketing your grain, if you're making forward sales, you have considerable time to make decisions. You can set price targets, you can manage basis and futures separately, and you can set yourself up to take advantage of market opportunities. However, if you simply wait to sell as you're driving across the scale, you are totally at the mercy of the market that day, just like I was with my birthday present shopping. I had no ability to price shop, and I was limited to whatever they had available to ship. So that can be a frustrating and defeating feeling, but just like a birthday that comes at the same time each year, harvest comes at the same time each year, and you also typically target the same time frame for hauling grain if you have on-farm storage. So we do have the ability to be more prepared and take control over our marketing decisions. We don't have to take the price when we drive across the scale. So to talk about what forward marketing is, so we're all on the same page, forward selling is simply contracting grain that will be delivered at a later date. For example, if we were looking at bids today and you're thinking, I want to sell grain that I'll be delivering at harvest, if you look at your local elevator's bid sheet and you see a bid like the one I have up here, posted for October delivery at $5.70 cash, if you decide to sell today for the bushel quantity of your choosing and lock in the cash price on those bushels, which you'll be delivering at harvest, you will make a forward cash sale. So because you created a contract today and locked in the price for grain that you'll be delivering later, that constitutes a forward cash sale. So now I have a poll I want to present to you all. So take a couple of seconds to answer that poll question that pops up on your screen. All right, so the results are in. We're kind of all across the board, but the majority is around that 0 to 50% range. Okay, so one question I do get a lot is, based on that, how much can I comfortably sell forward when there's still a lot of production risk? So even if you're sitting there now and you're thinking there's a lot of weather that could happen, I don't know for sure how much I'm going to raise. This is a common question because it can sometimes feel uncomfortable to sell something that you don't actually have possession of yet. However, your crop insurance is a part of your overall risk management plan, and it works in conjunction with your grain marketing. So you should feel comfortable selling up to your multi-peril crop insurance level. So you should feel comfortable forward marketing up to that level. And when making forward sales, it's also important to think about seasonal price patterns. So grain seasonality in the US generally results in low grain prices during the fall at harvest because there's an influx of supply hitting the market. And you can see that in the drop in the chart for both corn and soybean prices. The crop uncertainty in that early summer timeframe tends to allow for plenty of price fluctuation and volatility, which usually results in grain prices reaching their annual highs. There are, of course, outlier years, but this chart takes into account prices for corn and soybeans during the year using pricing data from 1980 through 2018. So you can see these price patterns are fairly consistent. What this indicates for new crop corn futures is that it tends to reach its highs between the end of April, beginning of July timeframe. And this should definitely be considered when you're thinking about locking in forward sales for harvest delivery. There's a general industry rule of thumb that suggests that for your pre-harvest marketing and marketing of stored corn from the prior year, that should all be done by July 4th to capitalize on this seasonal window. In terms of soybeans, the best time is around mid to late summer, as this chart indicates, about the end of May to end of July timeframe. And soybean prices in the US are heavily influenced by two growing seasons, South America and the US. That's why you'll see a lot of news about South America come into the picture in about February. That's when they start harvest. And if there's a big crop expected in South America, that usually weighs pretty heavily on the soybean market in the US in the winter. Once that crop is known and the US gets into planting season, the market starts putting back some of that risk premium that you see in that seasonal window. So these patterns are important to consider as you think about when to make forward marketing decisions. And we'll talk about that a little later when we talk about grain marketing planning. So overall, forward selling allows you to, one, manage your price risk, two, lock in profits when opportunities present themselves, rather than just waiting to sell when you're ready to deliver and having to take the price that's posted at that time. Remember that analogy we started out with birthday presents. The more time that you give yourself to make a decision, whether that's buying a gift or selling grain, the less emotional and more objective your decision-making will be. And in terms of a risk management plan, this also helps because you're not so focused on hitting a home run and selling all your grain at the highs of the market, but rather you're focused on pricing grain at profitable levels throughout the year so that you can be in the game and farming next year. So let's talk specifically about that. Let's talk about your cost of production and how to use that to create a grain marketing plan. Again, we will start with an analogy. So let's imagine that you are going to take over an ice cream shop that's been in the family from your aunt and uncle, which they've been running for years. It always seemed to have went pretty well for them. So instead of digging into the business, you simply keep everything going the same way. You source the same ingredients, you keep the same hours, you charge the same prices. However, you quickly realize that even though you're as busy as you can possibly be, you're barely making a profit. So you dive in to every cost of operations from ingredients to overhead. And what you find out in this process is that there are some other suppliers and ingredients that you can source from to reduce your cost. So you begin making some adjustments to your cost and you understand what prices you need to charge to hit your targeted profit margin. So you raise your prices slightly and you're able to pay yourself and invest in equipment upgrades in the shop. So there are a couple lessons to learn from this example that translate really well to farming. One is to dive into really understanding your cost of production. Just like the ice cream shop, there may be things that haven't been evaluated on your operation for a while. You might find that even though they've been doing things that have been getting things going pretty well with input and purchasing decisions, for you to be successful, you might have to make decisions differently. So in evaluating your cost of production, you may end up finding areas where you can reduce your input costs. In general, understanding your cost of production is hugely important beyond just the role that it plays in your grain marketing plan. However, in terms of your grain marketing, knowing your cost of production is absolutely critical because it should be driving your marketing decisions. And in my opinion, this is what helps eliminate the most emotion from the decision-making process as possible. So let's dig into the cost of production just a bit more. Simplistically, your cost of production is what it costs per acre for you to raise each commodity on your farm. You should calculate it by commodity because each one has its own inputs and cost structure. We're not going to dive too deep into this calculation because Farm Credit actually has some great e-learning modules on it, which I encourage you to check out. And the key with your cost of production as it relates to your grain marketing is using it to determine your break-even price. As those e-learning modules state, this can fluctuate throughout the season. So it's always good to reevaluate and make sure that your expected break-even is up to date as both your inputs get solidified and as your yield predictions change. So if you sell grain for a price above your break-even, you know that you're making a profit, and that's the key. So now it's time for another poll. Go ahead and take a few seconds to answer the poll that popped up on your screen. All right. So about half of you have spent some time. Otherwise, we're kind of spread across. For those of you who have spent significant time, kudos to you. We are going to cover why that is so important here in a second. So in terms of calculating your break even, the formula is to take your per acre cost to produce the commodity and divide that by your yield estimate. Most people use their APH in that case, and that gives you your break even price per bushel that you need just to break even. So that is no profit, but that's the price you would sell at if you were going to break even. So as an example, if your cost of production is $850 an acre on corn and your APH is 200 bushels per acre, your break even would then be $4.25 a bushel. Now, keep in mind that everyone's operation is different, and your cost of production and your break even are unique to your operation. You can utilize examples from things like university data, but make sure that you are digging into your actual cost of production. This does take some time, but I promise you it is worth it. If you don't do this, you won't have an accurate picture of what price you need to be profitable and what it means to your bottom line each time you make a sale. So especially in times where the prices are very close to our break even, a few cents can make a big difference. So if you're just doing a lot of rounding or using just some benchmarks, you won't really know for sure that you're selling above your break even. And ultimately, your break even drives your grain marketing plan. So let's talk about that plan. We'll look at an example plan in the next slide, but overall, an effective grain marketing plan uses your break even as a baseline, and then you establish incremental price targets from there based on your profit goals. So to determine the price targets you have, you stair-step them up from your break even. For example, if we think about the break even we outlined as an example on the slide prior for corn, you outlined your plan in January, and let's say you wanted to make your first sale above your break even. So maybe your first price target that you wanted to sell at was at $4.50 cash, and then your next target was at $5, and etc. from there. So you should outline then at each of those price targets the quantity that you want to sell. You can consider either how many sales you want to make each year, or I encourage you to think about the percentage of your production that you want to sell each time that you make a sale. And also important, which you'll see on the example, is to set sales deadlines. So that's why we talked about those seasonal pricing windows, because those can be helpful as a guide as you're thinking about the deadlines you want to place on making each selling decision. So let's take a look at that example. This actually comes from the University of Minnesota. The link down there is at the bottom. They have a great repository of grain marketing plan examples for both pre and post harvest for corn, soybeans, and spring wheat. So if you're looking for a guide, that's a great place to start. And as you can see, it doesn't have to be extravagant. It can be as simple as just taking into account your desired profit margin, determining sales price targets. You could just do cash targets if you're not comfortable yet managing cash and futures separately. And then outline the percentage of production you want to sell at each target. So this one does have a cash and futures target that you can see on each of those selling targets, and they base that on where they expect basis to be. But if you want to initially start, like I said, with just a cash target, feel free to do that. The important thing is just to write this down and start to get a handle on what prices that you're outlining. In this case, the incremental price targets are 30 cents apart. And then those decision dates that sell into the pricing window, those are also kind of staggered throughout as well. Ultimately, forward marketing 75% of production by mid-June or towards the end of that seasonal window. So in terms of execution of your grain marketing, you can translate your price targets into firm bid offers with your grain elevator or orders with your commodity broker. So using offers and orders actually allows you to execute this plan without the constant work and oversight by you. So you don't have to be consistently watching the market every second of the day and keeping an eye on where your price targets are. If you put in offers, you can say, I'm willing to sell grain this quantity at this price for delivery during harvest, for example. And if that hits, your contract will fill. So whether that's with a grain buyer or whether that's a hedge pricing order with a commodity broker. So you also want to be ready to evaluate your plan periodically. You may need to make adjustments depending on where the market scenario is and what percentage sold you want to be by a certain time of year. So personally for us, this year is a good example of why it's important to reevaluate. So when I first set up our plan this year, I had our price targets were fairly close together in relation to how the market ended up moving. And so if I would have put in all of those orders at once for my different price targets, they could have filled very quickly. And so as the market changes and the market environment gives you different opportunities than maybe you expected back at the beginning of the year when you set up your plan, be ready and be okay with making changes. This should be a living document and should be a guide. Also, make sure that you consider which types of contracts that you want to use. So take the time to understand what these are prior to actually having to make the selling decision. So like we looked at in that example plan, I'll go back there for just a second. The first one has that he wants to use a forward contract or a futures hedge or a futures fixed contract. But then the following ones have a pricing tool to be determined. The thing with leaving that as to be determined is that it can add some overwhelm to your decision-making process. So that potentially leads to indecision and adds a level of emotional decision-making to the game. So if you decide and think about and understand what types of contracts are available to you and are ready to use those when you're preparing to sell, that can be very beneficial as you think about your marketing plan. So speaking of contracting options, let's get in there and dig into a high-level overview of some contracting options that you have available to consider in both the cash and the futures markets, depending on your goals. But first, whose shop has ever looked like this? It seems like for me, when I'm asked a question to go get a specific tool, it's especially disorganized at the exact moment when I'm asked to go find something incredibly specific, like a particular screwdriver in a sea of screwdrivers. As much as I'd like to think that I could just bring any of them back to do the task at hand, that doesn't always work out. The thing is, if you try to tackle a job with the wrong one, sometimes it works out okay, but other times it's either less efficient, more difficult, or just plain impossible if it's not the right one at all. So as much as I'd like to think this is overkill to have that many screwdrivers, I can appreciate the fact that some are better for other jobs. Some are better for certain jobs than others. And the same thing is true for your grain marketing. Depending on your situation, there are a variety of contracts or marketing tools that you could use. Sometimes several contracts could fit the situation and your goals, but other times there is one that's the right fit for the job. So before we dive into a few different contract options, let's level set on our understanding of the futures market and the cash market, because there are contracting options that you have available in both. So in terms of the futures market, this market brings together buyers and sellers and establishes what the commodity is worth on a global scale. So if you check prices on bar chart or CME, you're looking at futures prices. And to determine that price, buyers and sellers make decisions based on global supply and demand, USDA reports, global and national weather during key times, and contracts in this market are standardized. So buyers and sellers aren't constantly having to agree on individual terms. That's why it's so easy to participate and buy and sell in the futures market. The players within the futures market include both hedgers, which is what you would be as a farmer hedging your futures price risk because you're protecting the price of the physical commodity that you're producing. But there's also speculators. So if you ever hear the term managed money or the funds, they buy and sell futures contracts simply with the intent to make money off the transaction, not because they're trying to protect the price of a physical commodity they'll be buying or selling in the cash market. There are also standardized delivery terms on each futures contract, but the physical commodity is rarely ever delivered. Rather, most are paper transactions. And for you as a hedger, as a farmer, you would want to get out of your futures position when you actually make the sale in the cash market. So in terms of the cash market, this is influenced by local supply and demand. So if you have a production issue like a hailstorm that wipes out the crop in the local area, that would be considered an influence on the cash market. Transportation costs, storage costs, those are all taken into account in the cash market. And in this case, contracts are not standardized. So you could sell as many bushels as you want to a grain buyer. You can sell one, you can sell 100,000. It's totally up to you. And grain buyers in the cash market are the ones that determine the cash price. And the way they do that is by adjusting their basis level. And in the cash market, the physical commodity, this is where it is traded and delivered. So like I said, if you do hedge your futures price risk in the futures market, ultimately you will still be selling and delivering in the cash market. So let's look at how these are interconnected. They both come together on the bid sheet. So when you look at cash bids for a grain buyer, each bid is calculated by taking futures plus basis equals cash. And basis is the component that creates a difference in the price you see between the futures prices on a bar chart or a CME, and then ultimately the cash price that you get paid by a grain buyer. This is determined by a merchandiser for that grain facility. So each grain buyer determines their own basis level. And this is influenced by local supply and demand dynamics. So for example, like I mentioned with a hailstorm, is this going to be likely to impact the futures market or the cash market? Most likely the cash market. Unless it's a widespread storm, it will likely impact your cash market because you'll have lower expected production in your local area. So your grain buyers who are trying to source grain will have a local supply issue and will likely strengthen their basis levels. But on the bigger scale in the futures market, it's unlikely to influence production that dramatically that would cause a futures price change. So all farmers sell and deliver grain in the cash market, but not all farmers use futures and options to hedge and manage price risk. The futures market is used to manage and hedge your price risk, but ultimately, as a farmer, you still have to sell and deliver in physical grain in the cash market. There are advantages to using the futures market to manage your price risk before delivering in the cash market, but on those same lines, I'd like to have you all weigh in. We have another poll for you. Let's take a couple seconds to answer that on your screen. All right, the results are in. Very few of you use futures and options often, but we have a widespread between some not at all and others who have used them a little bit in the past. So we are going to talk about some different futures and options strategies, as well as what options you have in the cash market. So it's good to know where you guys are all at in terms of your comfort level with utilizing futures and options. So some benefits, even though right now maybe you're just comfortable with the cash market, keep in mind that there are some benefits to hedging and understanding what it means to hedge using futures and options. But the level of importance of these benefits depends on your operations situation. So options can provide some downside price risk, and they can also allow you to capitalize on upside price potential. So sometimes you want that flexibility without just making a sale to limit your downside price risk. One of the keys too is that there's delivery location flexibility. So I'll give you an example of how we utilize hedging using futures on our operation because of the delivery location flexibility. So we have a few different facilities we can deliver to at harvest. One of them, though, will not take corn above a certain moisture level. So when we're coming into harvest, we don't necessarily know what we're going to be harvesting and what the moisture level is going to be. So we don't like to have sales on with that specific location that would lock us into delivering there, just in case all of the corn we're harvesting is wetter than that. There's also another location that we like to deliver to, especially with stored grain, but they can have crazy lines at harvest. So again, we don't love to forward market to the too many bushels there and then be forced to sit in a line. We want to be able to keep rolling at harvest. So we like to hedge using futures because then at least we can forward sell and lock in our futures price, but not be committed to delivering to a specific location. So we can make that decision when it comes down to actually having to deliver the grain, but we know that we've at least hedged our futures price risk. Additionally, using the futures market, there are some pricing strategies that are also available in the cash market that are packaged a different way or have a different name to them, but ultimately behind the scenes options are driving those pricing strategies. But if you actually use options and futures with a commodity broker, a lot of times to execute the same strategy can be a little less expensive. However, trading with a commodity broker does require you to have a brokerage account, and you do have to be prepared for margin if you're utilizing that. Whereas in the cash market, it may be a benefit to you to utilize some of those strategies so you don't have to worry about that. So let's look at an overview of the different contract types available within each market. In the cash market, we're going to look at 4 main contract types, one being cash and forward cash. So this is where you're contracting grain to lock in the cash price, either spot right when you deliver it or ahead of time like we talked about with forward marketing. An HTA, or a hedge to arrive, sometimes you'll see this referred to as a no basis established. This is a contract that locks in the futures price, but then leaves basis to be set later prior to or at delivery. A basis contract is a contract that locks in basis, but then leaves futures open to be set later. So you would use this if the basis level is good in comparison to what it normally is, but you still think there's opportunity for futures prices to improve. So you want to leave yourself more time to set that. And then there are non-traditional contracts. So you may have heard contract names like Pacer or minimum price or daily floor plus. And these are contracts that do utilize options in the background, but are packaged in such a way where you can understand the high-level pricing structure, but don't actually need to see the mechanisms that are making that work and don't need a brokerage account. In terms of the futures market, there are a variety of risk management strategies. So one is hedging using futures. And that means as a producer, you sell contracts in the futures market to manage your futures price risk. And then when you're ready to set basis or sell in the cash market, you offset those positions at the same time that you sell in the cash market. You can also buy a call option. So sometimes this is referred to as a courage call. So if you want to sell grain today, but you're still kind of worried you're going to miss out on upward price potential, this allows you to capitalize if prices do happen to move. So you can make a sale in the cash market today and at the same time buy a call option so that if the market does rally after you sell, you're still able to capitalize. Be aware that buying options, though, does come with a cost. So you have to be prepared to think about that cost in relation to your sale as well. And buying a put option protects a price floor. So if you're worried about prices falling and you want to protect your downside price risk, buying a put option is a good thing to consider. And then there are combination strategies. So those include simultaneously buying and selling different options, like buying a put and selling a call at the same time, or selling a call and buying a call. Commodity brokers definitely can talk through more of those strategies as well, but just know that that is an option. So let's look at an example. Let's say that you're looking at your local grain buyer's bid sheet for harvest delivery for soybeans, and the bid is $13.40 cash with a 50 under basis. So according to your marketing plan that you set up at the beginning of the year, your target was to be 65% sold by August 15th. And right now you're 50% sold. Your break even is also $10. So the next price target on your plan is $14 cash or $14.60 futures. So what are some contracting options that you could consider in the cash market? Well, today you could wait. You could keep your offer or order in place for the price that you outlined on your plan. But keep in mind, while there's a little bit of time for the market to potentially improve and hit your target price, time and seasonals are not necessarily on your side. So your target is to be 65% sold by August 15th, and seasonally prices tend to trend lower in August. However, the trading range for soybeans can be pretty wide, so a daily jump to reach your target can potentially happen. So this decision is all about your risk tolerance. Are you close enough to that price that you've outlined on your plan that you're ready to just make the sale? Or are you willing to wait a little bit longer and see if it potentially hits? You could also do a forward cash contract. So you could say, I'm close to my price target. I'm just ready to sell and get that next percentage of my production sold. The price is above your break even. So it's never a bad time to make a sale when you know that it's profitable and it is very close to your target. You could also consider a basis contract with a pricing order to set futures if you're still targeting that $14 cash. When you outlined your plan, your expected basis was 60 under. So today that's better than what you were expecting when you created a plan. So if you don't see that improving, you might want to lock it in and then set a pricing order just to set that futures price to accomplish your $14 cash target. Now, what are some contracting options in this same scenario that you could consider in the futures market? One would be to sell cash and buy a call option. So this would allow you to reduce your price risk while still having a chance to capitalize just in case the market moved higher, but you must be willing to invest in that call option. You could also hedge using futures or use an HTA in the cash market. Those two accomplish the same goal of locking in your futures price. So if you're satisfied with the futures price and it's close enough to the goal that you set, but you think basis will improve, or at least you don't expect it to weaken, if you're not concerned about having the delivery flexibility, you could just do an HTA with a specific grain buyer if you want to leave basis open but lock in futures. If basis is at a good level and you want to lock it in today, then you could consider that cash contract like we talked about in the last slide. So overall, it's important to remember that there is not one right answer. Your decision depends on what you're trying to protect, the delivery flexibility you need, and overall your risk tolerance. So now let's recap. While we covered a lot of content in a short amount of time, I hope that you have more clarity on why grain marketing doesn't have to feel like an emotional roller coaster. There are 3 things to consider to help you keep that emotion at bay and make more objective grain marketing decisions. One is to think about forward sales, so you can execute when the market gives you opportunities to do so and not feel quite as at the mercy of the price that you're getting that day that you deliver. In conjunction with forward selling, knowing your cost of production and building a grain marketing plan is ultimately how you determine your sales targets. And finally, once you have those sales targets in mind and an understanding of your situation, take the time to understand your contracting options and what you plan to use depending on what the market environment is like. So with that, I hope that you've got a better understanding of that emotion piece. And if you're interested in those online courses, Cash Grain Marketing 101 or Grain Marketing 201, feel free to scan the QR code. And Rebecca will also include some information on how to get enrolled in those in the follow-up email that will come after this webinar. So keep in mind, though, enrollment is open now, but it does close Friday. So if you're interested, be sure to check out the information there. And now let's open it up for questions. Do we have any that have come in, Rebecca?
Yeah, thank you so much, Brittany. Just a reminder, we do have a couple minutes here for questions, so feel free to submit those. We'll get to as many as we can. One that did come in is you mentioned that we could use offers and orders to execute the pricing targets we outlined in our plan. Can you expand on how a firm bid offer works?
Yes, great question. So a firm bid offer in the cash market, I'll give you an example of how that would work. So if I am targeting a certain price for my harvest bushels, let's say I want to sell at $6 cash, I would call my grain elevator and say, I'm willing to sell 10,000 bushels for $6 cash delivery at harvest. And if the market trades to that level, it will automatically fill for me. So the benefit to that is that I don't have to keep reviewing the bid sheet and seeing if it's reached $6, picking up the phone, making sure that I call and get that contract locked in. It's very hard to reach your price target that way. So with a firm bid offer, that automatically executes, and it also can execute in the overnight trading session. So you might not be able to call your grain buyer and sell grain overnight, but your offer, if it's out there working and it's a firm bid offer, it will fill if the market moves in such a way that it reaches that price.
Awesome. Thanks for that. Another question that came in, can you define basis? So maybe dig in a little bit more. I know you talked about it some, but maybe a little deeper dive.
Sure. Yes. Basis is one of those concepts. Like I said, I even had a tough time understanding it and how grain buyers are basis traders when I originally started out in grain marketing. I do get very in depth in Cash Grain Marketing 101 about basis, so I would encourage you to check that out. But overall, basis is how a grain buyer makes money from storing grain that they buy from you and then selling to an end user or for export. So they manage basis to be able to make sure that they are making money off of buying your grain and then ultimately selling it to their end users. So they're taking into account, their cost of operations and storing that grain, as well as what they're able to sell on the other side of it. So grain buyers are basis traders. And so they look at that basis level between where they're buying it and also where they're selling it to determine that.
Great. I know you said you have a great passion around helping kind of young and beginning farmers. Can you share, when you work with these folks, what's kind of a common mistake or a big mistake when people are just starting out, and maybe some steps they can take to avoid making that?
Yeah, great question. So I think just not having enough focus on grain marketing and understanding your options, as well as that cost of production. So especially when you're starting out, your situation is so different than potentially the others in your operation that have been in it for a long time. And so just making the same marketing decisions that they're making might not fit the best for your operation. You might have to be more cognizant of your cost of production and really get that down specifically, versus just kind of having an overall idea of it, like maybe other generations on your operation are able to do, just with where they're at in their farming career.
Great advice there. And I appreciate the call out that we do have some resources available to kind of help dig into cost of production. So definitely take a look at those. A lot of great resources with our different land grant universities as well. We're just about out of time here. So if I can close with one more question, is there one piece of advice you'd like to leave our listeners with today?
Oh boy, I would say create a grain marketing plan. So if you have never done that before, write it down. So as I mentioned, it can be very simple, but just outline those price targets, because as you're watching the market fluctuate, that's where a lot of that emotion comes from. And so if you can look back at something and say, I know this is a profitable level, I determined this at the beginning of the year as being a target that I have, it just makes that decision to sell grain when the market reaches that level much easier. So if you take something from this, I hope that you do go try and create a grain marketing plan.
Really great advice to end on. And I feel like that's been a theme on a couple of our webinars, that idea of writing something down, making it easier to actually put that in practice and to help hold ourselves accountable. So really great advice to end on there. Well, I want to thank you, Brittany, for taking time with us today. A lot of great information. As she said, we will send out some additional information about her courses and how you can get involved with those. Otherwise, thank you to everyone in the audience. We appreciate you calling in and submitting your great questions. We'll be back next month on September 7th, where we'll be covering how to deal with family negotiations when it comes with transition planning. So again, that was one that came in on a survey. So keep that feedback coming. We'll see you next month on September 7th. Until then, take good care, and we hope to see you online soon.